Hey, this is Mitchell from Optional. Today we're going to be going over intrinsic value and time value. Now, those are the two main components of how options contracts are valued, so let's just dive right into it here. Intrinsic value is essentially the amount of dollars an option contract is in the money. An out of the money contract would not have any intrinsic value and would be totally comprised of time value. So all contracts will have time value associated with them so long as there's time left on the contract. When purchasing option, that time is working against you, meaning every single day that option contract is losing time value. So for example, a $12 put option on a stock that trades currently at $10 would have $2 in intrinsic value plus its time value. So this option is considered $2 in the money, giving it $2 in intrinsic value. So again, time value, an out of the money contract would not have any intrinsic value and it's totally comprised of time value. So as an example, basically on the other hand, an $8 put option on the same underlying stock that trades at $10 per share would have no intrinsic value and would be totally comprised of that time value. So if this contract were to expire while the stock's trading at $10 per share, the contract would have no value. So being that time's always working against us in these strategies, it's common to exit the position before expiration. So when you're purchasing call or put contracts, there's several expiration choices. One may be just to sell the contracts before they expire. That's the most common way to exit the position. Another would be to exercise the contract by buying or selling 100 shares per contract at the strike price before the expiration date or on the expiration date. And the third would be to let the contract expire worthless, which is what will happen if you hold a contract until expiration and it expires out of the money. So again, time value deterioration, it works against you when you're long options, works for you when you're short these options, and when you're shorting these options, you're essentially selling time. So again, out of the money contract, in a summary, out of the money contract is all time value. In the money amount is intrinsic value. Time value plus intrinsic value is the value of the contract. So this is actually, there's a formula behind this called Black-Scholes. It gets more complicated with these Greeks. It's going to be discussed in another video, but that's going to be basically just the basic of it here. Again, just sign up for our videos. You'll get a lot more educational material and a lot more resources. And that is intrinsic and time value. Trade safe.